Hello and welcome to another episode of Real Estate Roundtable with MRTG Capital. I'm Tom Gooch, and as always, I'm with my friend and business partner, Mr. Mike Rome. How's it going, brother?
I'm doing great. How you doing?
I'm doing great too. We're switching up times. We're recording. We record at all hours of the night, of the day, and this one's probably been the best so far, I think, for us. So,
Yep,
doing
that's
great.
convenient.
Hey, so real quick, all friends and family who tune in here, so we always greatly appreciate you for tuning in and watching us talk about topics for our investors and potential investors. For this one, we're going to keep it, pretty short, pretty concise, just quite simply because not every topic that we do ends up on Facebook, meaning we have to throw it out on YouTube and throw it out on the other, obviously, podcast platforms because Facebook has a shorter duration for that. So we'll keep this one short for you because this is a topic we want to make sure that everyone, no matter where you're tuning in at, hears. And it was one where we talked about recently. We heard a lot of people, a lot of feedback saying, hey, why are you still investing when interest rates are at, where they're at today?
Yeah.
They're hitting 8%. Like, how do you have investors come in when normal, even home buyers can't even buy a house? Right? Like what was $1,000 payment today is, twice as much, yesterday is twice as much today kind of thing. And that was one thing where obviously we have the answers for that and we know why, but we wanted to be able to provide that information for you, our investors and also potential investors. So Mike, let's talk about that then. So why, from a real estate investing perspective, how does that make sense for us? What do we look at? Where do our minds go to and what does that mean for our investors?
So first off, I know you mentioned it's about 8% today. World. Last year before, it was 3%. I even heard some people in 2%. Heard other investors say scared money doesn't make money. And that's the biggest thing here. I mean, you just got to evaluate your deal. In today's world, it being 8%, what you need to do is get the purchase price down. Purchase price is the one thing that you can't change after the contract is executed. So you close on a deal, you can't go back and change that price. Financial rates, you can refinance, you can do whatever you may need. So even though it's not cash flowing the strongest at 8%, if you have the purchase price at the right price, you can go and refinance a year or two down the road. And if rates are going to drop at some point, we just don't know when. But if they maybe not hit 3%, maybe they're at 4 or 5%. There's going to be a gap of 3 to 4% savings that's going to bring your cash flow up on a monthly basis. It's just today, it's not going to happen. So it's a long-term play. I mean, you have to look and see, hey, is purchasing this at X amount of dollars with an 8% interest rate still positive cash flow? Know that in a year or two, that hopefully those rates come down and your cash flow is going to go from this big to a lot more. So
that's right.
Absolutely a long-term play compared to today scenario.
Yeah, and when we talk about shares, like different, you're buying a certain class of share, right? So for example, let's say that you're an investor that cares specifically about cash flow. You don't care all about the upside. You want, your cash flow now, and you get that preferred return before the other classes of investors get theirs. This is still, with these interest rates, still comes into play for you. And once again, the cash flow is one aspect of that. Now, obviously, is our litmus test. If it cash flows any deal, then obviously it is a good deal. If we're losing money every month, it is not a good deal. It's very, very simple, very binary from that standpoint. But with that being said, what you said was this, right? Like, yes, it may be 8% now, but it's still cash flowing. You may not, and this is where when we talk about, the internal rate of return, when we talk about what your equity multiple is every single year, it will change, but the deal will get better as it ages as well. Absolutely. Right? And we buy not just for today, but what will that market look like in a few months? What will it look like for a year? Right. And what will the interest rates like as well?
And as you can tell, right now there's more inventory because it's 8% interest. People are backing off from purchasing. So there's more interest, more inventory. Whenever the rates drop again, inventory is going to go scarce again, and it's going to be back to a seller's market. Prices are going to shoot up higher, and then it's going to be tough to find a good deal again at that point. So also, how we said, you have to purchase it at the right price. If we get it at a lower price right now, that appreciation factor. So you were talking about the cash flow, the appreciation of the building is going to go higher at that point. So
that's right. That's perfect, right? And actually here, just to keep it short and sweet, I don't know where we're at right now. Our video editor is going to be like, cut it, guys, cut it. But we buy the deal today. We're going to, obviously share those with you in our investor deck. But with that being said, we'll cash out refinance and you'll get that mailbox money. Cash flow goes higher. So lots of exciting things are actually happening now that it may seem a little scary, but it's actually very, very exciting. Awesome. Well, hey, that is all that we had for today. Appreciate everyone. And as always, stay invested and stay informed. Till next time.
Thanks, everyone.
If you would like to connect, please head on over to mrtgcapital.com and request time to meet with us to answer any questions you may have about real estate investing through a syndication. We partner with small groups of investors just like you, and we're always reviewing deals that could be of interest to you.